Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 250th podcast VideoCast for the week ending August 1st, 2024. What an exciting month July was. August, off to a rocky start, but that's normal in the first few days of the month, and a couple of exciting things going on that we'll share with you. I want to get right down to it. First and foremost, want to thank my buddy Chris down in Dallas for sending me this new mug. He sent me two mugs, or actually a bunch of mugs when we did the 200th episode. And this one's white versus black, and then there was also blue Great Hill Capital ones. This one says on one side hedge fund tips, and on the other side opinions, not advice, see terms. So now I can just say that everything. Go to Hedge Fund Tips, see terms. Thank you so much for thinking of me. Also want to welcome on board all of the new clients and acknowledge the existing clients that have been with me for a while. So welcome Jim, Blake, and then obviously Rob, Chris, Woody, Philip, Seema, Sandeep, Stephen, James, Lorraine, Dale, Andrew, Steve D, Paul, Pat, John, Micah, Craig, Sherry, Frank, Srini, Lakshmi, Chris, Brian, and Abhishek. So grateful. And just the beginning, ladies and gentlemen, a lot of exciting stuff. So this was from the girls' summer swim club meet. They were down at Darien this week. They won the meet. Pretty exciting. That's Caitlin with Mimi and Annabelle. That's me with the USA water polo mascot out in California last week. And then let's see. That's Caitlin and I at Stanford. And that was the water polo meet. That's Mimi. That's me at that Stanford Tower. And then me with Annabelle. The girls did great. Their teams came in. 10 and under came in. 4th out of 100 teams, give or take, I think 96. And the 12 and under, Mimi's team came in, I believe, 10th or 11th out of 100. So pretty darn good. Very proud of them. Was a great trip. We will be in Hampton, Virginia, which is near Virginia Beach and Newport News, or areas down there, from Tuesday or Wednesday through Sunday of next week for their zones championship for swimming. So if anyone down there, new or existing or potential clients, wants to meet for a coffee, or if you belong to a club and want to play golf, love to meet you down there, can get us on a good track, reach out to me at the contact form here. And love to meet podcast listeners, clients, etc. In person, which will be fun. So with that said, let's get to the markets overview. We'll do the media, and then we're going to get down to a lot of data, a lot of earnings. This is a catch-up. I mean, I know last week wasn't short, but it was shorter than normal. So first, I want to thank Neil Cavuto and Jenna DeTomasis for having me on Fox Business Cavuto Coast to Coast this week, and we're going to listen in now.
Another Thomas I want to go to is Thomas Hayes, the chairman and managing member of Great Hill Capital. Thomas, you heard the other Thomas and what he was saying about the environment for this. We don't need a cut right now, but the markets certainly are anticipating, not necessarily from today's meeting, but Alan Miner, of course, the former vice chair of the Fed, they made a credible argument for doing that. But that aside, market rates are very low. I was just looking at a 10-year in and out of 4.09%. Maybe you don't need to do anything. Maybe the markets are doing the heavy lifting for the Fed. What do you think?
Well, in anticipation of the cut, you do have the Fed funds rate over. So the 10-year yield is compressing. And in the event that they walked back the cuts, you would see that 10-year yield shoot right back up. The markets would be down. So it's a little bit of
would that apply? I'm sorry, properly. But would that apply if they do nothing? In other words, if they do nothing, I guess the big issue today is what they signal, or Jerome Powell signals when he talks to reporters. And if he sets the stage for September cut, how do the markets deal with that?
Yeah, I think that's baked into the markets right now. I think the surprise would be if he said maybe September is not on the table, the markets would react. But you're seeing it. Look, the rotation has begun. July was a turning point. We saw the dramatic rotation in anticipation of one cut in September and possibly another in December. So the market likes that. The market is acting accordingly. But what's interesting is tech and communication services up to this point for the month of July were negative, while banks were up 16%, real estate was up 7%, utilities was up 5%. So this is kind of baked into the market at present.
Let's talk technology real quickly, Thomas. I mean, what the market taketh away and giveth back with a vengeance, and Microsoft is getting the credit for this, even though its numbers failed to impress, especially its cloud database and business and all the rest. But the fact of the matter was, it did indicate it's spending a heck of a lot of money on artificial intelligence in every facet. That was deemed, along with the AMD news, as a sign that this AI spending is still strong, and it's lifting all the chip makers. So how do you interpret that? How long live do you see this? Play it out for me.
Yeah, well, Neil, we have an AI arms race between Microsoft, Google, and Amazon. And the AI arms dealers are the short-term winners, NVIDIA, Intel, and AMD. But I think that's going to change. So like you said, Microsoft's CapEx was up 77.6%, while their revenues were only up 15%. Sequoia wrote an article about a month ago called The $600 Billion Question. And basically what they said was, given the amount of CapEx that these companies are spending on GPU chips, they would need another $600 billion. And we're back. Then I want to thank Melanie Schaefer of CEO.ca. It's out of Toronto, for doing a long form interview with me that gives you some context as to what's happening under the surface. So we'll listen in now.
I'm excited to be joined today by Thomas Hedge, Chairman and Managing Member, Great Hill Capital. How are you doing today, Tom?
Doing great, Mel. Thanks for having me.
So we're talking during a huge week for the market. The U.S. Federal Reserve is meeting as we speak, and tomorrow the central bank will announce its decision on interest rates. We also have 4 companies within the Magnificent Seven reporting earnings. We'll get into the rotation that you've been calling for a long time in a minute. But what should investors expect to see from these earnings and the guidance that's issued? And will the Fed cut rates tomorrow?
The million-dollar question, will the Fed cut rate tomorrow? Well, look, I think just as important as the Fed's decision is, more importantly, is actually the Bank of Japan, because we've had this theme, Mel, where Bank of Japan has been the global liquidity provider with unlimited quantitative easing, not only buying JGBs and U.S. Treasuries, but actually buying domestic and global equities. Well, that gig is up, and they are now in a tightening period. They've wanted inflation for many years. They now have it, and all bets are on that they could be raising rates almost as we speak. I know their meeting is happening, and we'll know in the next 24 hours. So as they start to withdraw that liquidity from global markets, the pressure is on the Fed and the ECB to now step in and be a global provider of liquidity. I know there are some traders and investors who think tomorrow and this week may be a live meeting for the Fed. The odds don't favor it. Chair Powell, other than his autopilot debacle in December of 2018, prefers not to shock the market or surprise the market. So my sense is it's going to be February, in September, where consensus currently is that the first cut will be in September. Based on Dudley coming out and a couple of others, and some of the weakness that we're seeing in the employment stats, it wouldn't be unjustified to cut tomorrow, but I think they have not done a good job of preparing the market if that was their intention, and therefore we think September is going to be the base case for the first cut and December the second cut.
And what about for the big tech earnings coming out this week?
Yeah, the big thing here, Sequoia put out a great white paper a few weeks ago called the $600 billion question. And what they basically said was all the CapEx that we're seeing on AI chips and semiconductors is fine, except for the fact that it would require $600 billion of new revenue to justify the cost. And they break down SaaS margins and et cetera. And what we saw with Alphabet was a concerning trend where the capex was very high and the revenues were not yet nearly supportive to justify that capex. And you've effectively had an arms race with all of big tech trying to hoard as many high-end chips as they possibly could, as quickly as they could, so that their competition didn't have it. But the revenues that support that level of spend are nowhere to be found. So there's a fear about margins. There's a fear about how long will it take, if ever, to fill that $600 billion revenue hole, commensurate with the capex spend that we've seen and the front loading of the chip hoarding. So, I think that big tech and Magnificent Seven have come in a reasonable amount, but it wouldn't surprise me. Look, I would say this. It would surprise me if this was another 2000 tech wreck. I don't see that coming because these are huge free cash flow generators, which was not the case in 2000. So I wouldn't compare it to that. But I think prospectively, certainly for the next 9 to 18 months, we should see a scenario where, irrespective of tomorrow's earnings or the day after's earnings, where the Magnificent Seven as a basket underperforms the unmagnificent 493, i.e., the second half of the year, we should see more subdued general indices because of the weights of Magnificent Seven within the market cap weight indices, and huge, monstrous opportunities under the surface for the left behind stocks. I mean, you saw a couple today that we've talked a lot about on our podcast and in public TV appearances. PayPal is up 7-8% today on beating earnings. Stanley Black & Decker, talk about old world, is up 7 or 8% on beating earnings. So there's a lot of great stuff happening under the surface that gets no headlines, while everyone's overcrowded into the Mag 7. That the air is leaking out of that balloon. I wouldn't say it's going to pop or anything like that. I would just say it's going to be much more subdued for the near term.
Yeah, so you've been calling for a rotation out of the Mag 7 and big tech into small caps, even though, as you said, there's been a lot of skepticism around that idea. Now we see that shift appears to have started. Can you walk us through your thesis and what you see happening into the end of the year and even into next year? I know on your podcast you referred to 2025 as the year of the small caps.
Yeah. I think we've started in 2024 and we'll see more of that in the second half of 2024. And that should continue into 2025. As a matter of fact, historically, since World War II, small caps outperform large caps by about 11% in the first 12 months after the first cut. So if our base case is correct and September is the first cut, that would imply a meaningful outperformance again for another 14, 16, 18 months, the first part of that easing cycle. And I think that's going to be positive. But, a lot of people are skeptical that, there have been several fake outs, et cetera. And I think what's different this time is the earnings composition has dramatically changed. So we started the year with enormous earnings growth for the Magnificent Seven. With the first quarter alone, they had 50% earnings growth, 50%. And the unmagnificent 493 had negative 1%. So it's no wonder that they dramatically underperformed the 493 and the Mag 7 dramatically outperformed. The earnings growth was there. Well, that composition is changing. It's expected by the fourth quarter that the unmagnificent 493 will have 19% earnings growth and the Magnificent 7 will have 17% earnings growth, which is why I say they'll be fine. They're just, in our view, going to underperform because they're decelerating in earnings growth versus the rest of the market is accelerating. And then as far as supporting the underlying thesis in small caps, in addition to cyclicals and the unmagnificent 493, the earnings growth this year is about 4%. And next year, it's expected to be 17%, whereas large caps are going to be 14% earnings growth next year, and they're 12% this year. So it's not a hope or a wish. The only thing that could change that thesis would be a dramatic change in earnings expectations for small caps versus large caps. And so far, we're not seeing that. So far, it's actually right on schedule, and we're going to see more of that. I think in the last few days or so, where you saw a little hiccup when Kamala was announced as the candidate, you saw tech start to take off, and the unmagnificent 493 take a little rest. But I think that was also a function of they moved so far so fast. I think it was something like 13% in a week and a half, small caps as a basket moved. It was just an excuse to rest. So irrespective of the president, who's elected, et cetera, I think this trend is going to persist because the composition and the cost of capital cycle supports it.
Well, the Russell 2000 is up about 11% since the second quarter ended now. How should investors be positioning themselves for a longer term shift, and what data should they be paying particular attention to?
Yeah, I think a couple of things are going to take place. Number one, the unmagnificent 493. So there will be large caps that do extremely well that have lagged, the non-magnificent 7. Then you've got anything interest rate sensitive. So dividend growers. Stanley Black & Decker is a great example of that. Cyclicals, REITs are another one that have been left for dead. They're the most under-owned since 2009. Everyone's calling for a commercial real estate apocalypse. We think there is some truth to that, but it's mostly going to be in the B and C properties. This is analogous to the mall debacle, 4 or 5 years ago, where the A malls wound up doing better, and the Simon Properties of the world that have Lululemon and Apple stores and all the things that people want to go to, and then the B and C malls that were anchored by J.C. Penney and Sears had been a train wreck. I think it will be similar for commercial office. I think there's a little bit of froth in the multifamily in certain areas in the country. We'll see some of that. But I think it'll be a slow motion unwind, and lenders incentivized to extend and pretend. So it won't be an acute, abrupt type of pop. It will be more of a slow leakage that can be contained, and the rest of the market can pick up the slack. The other thing that's happening at the same time, Mel, that few people are focused on is we have been in a dramatic recession for the last 2 years. It's just been contained. Well, it started with the 2 quarters of negative GDP growth, and in 2002, first quarter, second quarter, and it was supported by a massive manufacturing slowdown, the destocking cycle. That has now bottomed and is starting to turn up. We're starting to see more positive signs, slowly green shoots where manufacturing is coming back. And we're certainly seeing very green shoots for the destocking cycle being in the rearview mirror and the restocking cycle just starting. And that's not the time that you hit tops in markets or ends of cycles. That's more the time when you hit second legs and refreshes a cycle. And that's what we're starting to see right now, as evidenced in Stanley Black & Decker is a great example of that this morning. They spent 8 quarters destocking, and now they're restocking. Their free cash flow is going through the roof. They paid down a bunch of debt. They've taken the costs out, and we're seeing that among many of the unmagnificent 493.
Can you give us a rundown of 3 stocks that you're bullish on into the end of the year?
Yeah, I can do that for sure. We love PayPal. We've liked that for a while. It's been dead money for a number of months, but I think today was the breakthrough quarter. We saw the revenues were up 8%. Their earnings were up 17%. Their payment volume was up 11%. Their free cash flow for the quarter was $1.4 billion. I mean, how many quote unquote turnaround situations do you see that they're generating $6 billion of cash per year and you can't give the stock away? So, and their margins are coming back. So they not only took guidance up, they said, by the way, we're not going to do $5 billion of free cash flow. We're going to do $6 billion of free cash flow. Oh, and by the way, remember how we said we're going to buy back $5 billion worth of stock this year? Yeah, we changed our mind. We're going to buy back $6 billion worth of stock this year. So Alex Chris, who came from Intuit, he ran the small business division, which was responsible for 50% of the revenues of a stock that went up 20 something times during his tenure, 20x plus. has taken the reins of PayPal, and he laid out his plan earlier this year. It fell flat, but he's executing, and we saw that, and we're seeing the movement in the stock price today, and we believe it's just the beginning of many good things to come on PayPal. And then Stanley Black & Decker, as I said, they sold a non-core business, paid down $1.2 billion of debt. Their cost reduction plan to cut $2 billion of costs by the end of 2025 is almost 75% done. They've taken nearly $1.5 billion of costs out of the business. The business is inflecting. They have DeWalt, they have Craftsman, they have Stanley, they have Black & Decker. So if you believe in construction and you believe in manufacturing and you believe there's going to be an increased demand for tools and you believe in the housing shortage and you believe that the millennials are going to continue housing formation for the next 5 years, you want to own Stanley Black & Decker, or at least we own it. You should do whatever you want to do, opinion, not advice. Then, we like, as you can tell, we like durable businesses that are temporarily out of favor. We like Disney, okay? You can't give Disney stock away. They just had their greatest box office of an R-rated movie in history with Deadpool and Wolverine. I didn't get a chance to see it, but I guess I'll have to now as an owner of the business. And we look at the sum of the parts. And what's fascinating about Disney, there's so much pessimism and noise around Disney. But if you do the sum of the parts, the parks and the experiences and the consumer products do about $10 billion of EBITDA. It's probably a little bit more now. So that's worth about $80 a share. Okay, as of a couple of days ago, the stock was trading around $90 a share. It's bumped up a little bit since the weekend. Still incredibly cheap. What that means is effectively the market is assigning zero value to Disney Plus, which has 153 million subscriptions, ESPN, which is the number one sports property in the world and currently gaining share, not losing share. You've got Hulu, you've got the TV networks, and you have the movie theatrical releases like we saw this weekend and we saw with Inside Out 2, which was a huge success. That's going to be another multi-billion-dollar blockbuster. And the market is currently assigning, for all of those pieces of the business, Mel, the market is assigning $0 of value. Those business on a normalized run rate are going to do $15 billion of EBIT, we believe, which implies that the stock could, over the next 3 to 5 years, in our opinion, could be $180 to $200 stock. So basically a double over a few years as the market starts to recognize that. And that's not like wish or hope. If you look at Netflix, it's got 270 some odd million users, and they get about $250 million worth of value attributed to the value of those subscribers. So even if you say, well, Disney's are only worth half as much, there's $100 some odd billion that's not yet priced into the stock. We think there's tremendous opportunity. And then finally is a boring business called GXO Logistics. This is one of Brad Jacobs' companies. And Brad Jacobs has the Midas touch. He's done, if you had invested $1 million with him when he got involved with United Rentals, you would have made 47 times your money over a number of years. If you had gotten involved with XBO Logistics in 2010 when he got involved, you would have made 31 times your money. So $1 million becomes 31 million. And GXO Logistics was spun out of XBO. They do outsourced logistics, supply chain, reverse logistics, order fulfillment, etc. And they have guided that they're going to nearly double adjusted EBITDA by 2027, which implies you could get nearly a double in the stock, except for the fact that when your growth rate accelerates, as it will with these assimilations of some recent acquisitions that they've done, not only do you get the doubling in terms of stock price, you get some multiple expansion as they start growing and continue to grow top line and bottom line by double digits. The market will pay a premium for growth. And that's why we think this one as well could be a double plus over the next handful of years, and a huge track record of success and a huge total addressable market of $430 billion, which they've only got about 5%. They're the second largest player, basically a duopoly with DHL and a fragmented business, and huge open space for them to grow.
And lastly, Tom, just because we're running out of time, and I know this isn't your favorite thing to talk about, but as the U.S. election cycle continues to heat up, can you tell us what the stock market wants to see in terms of who ends up in the White House and which party or parties take control of the House and the Senate?
Yeah, that's a fair question. Look, I think at the end of the day, empirically speaking, what's worked historically is when no party controls all three branches. So the worst case scenario would be if you have either all Democratic executive, Senate, and House, or an all Republican executive, Senate, and House. That's bad for the stock market. Bad meaning it will perform less well than when you have a situation of gridlock where one party controls at least one of those three branches. And that's effectively what we want to see. Whether you're on the right side of the spectrum or the left side, what you should be hopeful for is that your party does not win all three branches if you own stocks, because what works best is gridlock. The market likes when politicians are limited in their ability to get stuff done, because the more they do, the worse it tends to get. So we'll leave it at that. And let's hope for gridlock, and whomever you hope gains the executive branch, just be hopeful that they're checked in Congress.
It's definitely going to be interesting. There's lots to watch over the days and weeks ahead.
Yep.
Again, Thomas Hayes, Chairman and Managing Member, Great Hill Capital. Thanks again for joining us, Tom.
Thanks, Mel.
And we're back. And then finally, I want to thank Sean Calebs and Ryan Gallagher for having me on CGTN America last night to talk about the Fed's developments. We'll listen in now.
Well, what the Fed does or doesn't do is always big news. To talk more about this latest decision on interest rates and what it's going to mean for the U.S. economy moving forward, let's bring in Thomas Hayes. Thomas is, of course, the founder and chairman and managing member of Great Hill Capital, LLC, a long-short equity manager based in New York City. Thomas, always a pleasure. Great to have you back.
Thanks for having me, Sean.
Okay, let's dissect what Jerome Powell had to say. Really no surprise, as John Terry just told us, that there wasn't a drop in interest rates today. But your thoughts on the language that he used about a potential cut in September, saying it will be on the table. So do markets build in that they're expecting this cut? And then if it does or doesn't happen, what are we looking for the next 8 weeks?
Well, Sean, I think the market has already built it in. Fed funds futures had been pricing nearly 100% chance of the first cut in September. And what we saw in the month of July was that the great rotation in anticipation of that began in earnest. As a matter of fact, if you look at, as of this morning, you had tech and communication services for the month of July were nearly flat, were a little bit negative, might have closed barely positive, but banks were up 16% on the month. Real estate was up 6.9%. Utilities was up 5%. Equal weighted S&P was up 5%, whereas the cap weighted, the normal S&P 500 was only up about 1%, maybe a little bit more at the close. And then small caps were up 10%. So the market has already started to get ahead of this. And the language, as you stated, Sean, did in fact change to be more predictive that he is moving ahead. As a matter of fact, there were a few Fed members he alluded to that wanted to go in July.
Wow. Okay, so to talk more about what happened, what areas of the economy is the U.S. winning the fight against inflation in? Because that obviously is going to be first, second, third, fourth, fifth on the list, leading them to make that decision one way or the other.
Well, we're seeing disinflation. So we saw McDonald's, for example, had sales down 1%. The big two things that have been holding up inflation were auto insurance and auto prices, which have started to come down, and owner's equivalent rent, which has been on a lagged basis, which has also started to show some signs of weakness. Wages grew at just 0.8% in the second quarter. So that was the softest since 2020. So everything is showing signs of disinflation, but he did emphasize the dual mandate, and he started to make the case again that he was focusing just as much on inflation as now he is focused on employment. He doesn't want to see material cracks in or weakening in the labor market, which he's focused on like a hawk, which, just a month or 2 months ago, he was only focused on inflation. So this is a key turning point, and he's seeing what the market's seeing, and that is he's going to have to move pretty quickly, certainly in September. As a matter of fact, Citi was out today saying they start in September and they go all the way down to 3.5%, which would be, 4 or 5 consecutive cuts in a row.
Wow, that'd be interesting. Now, also, we've heard the Fed talk about it's important to not act too soon, but you certainly don't want to act too late, which is what you're talking about right now. So if the economy is moving closer to its 2% inflation target, but there's still no question that consumers are feeling the bite. You talked about some, but people still grousing, obviously, about grocery prices, housing. Talk about some of the problem areas and the frustration that people deal with day in and day out.
Yeah, there's no question. I mean, the real issue is incomes have actually risen slightly faster than overall inflation, but it hurts people at the lower end because inflation is taxation without representation, is basically what it comes down to. It hits everyone, and it hits people with the lowest discretionary income the hardest, people that have to pay for regular necessities, food, gasoline, et cetera, on a daily basis, rent on a daily basis. And those prices, unfortunately, are not going back to pre-pandemic levels. The best we can hope for is that they go down to increasing by 2% a year, which is the goal. But the Fed has indicated they have to move before that target is hit. Otherwise, you run the risk of deflation. And, the key thing here is it's binary. If they move too quickly, they have a quick tool to bring it back in. They can start hiking again. But if they move too slowly and disinflation turns into deflation, that can be extremely costly and hurt a lot of people. The saying is most people would rather pay an extra $1 for a gallon of milk and still have a job than have no job. And he's focused in on that right now, and that's what's causing him to move in September.
Yeah, quickly, those with retirement accounts, they've had a pretty good year. Market's doing well. Now, if there's a cut in September and another at the end of the year, tell us what you believe is going to happen to the markets, and if that doesn't happen, what's going to happen to the markets?
Well, I think you shouldn't think about a retirement account in a quarterly basis. You should think of it in years. However, it would be natural to see some short-term volatility ahead of the election, which is, late September, early October, and that just happens to line up with the Fed meeting on the 17th, 18th. So coincident or causal, it wouldn't surprise me if we see some continued strength over the next few weeks and then some fall volatility along the lines of the election and or the Fed meeting in September. It could be, and a lot of people are pointing to, it could be a short-term sell the news before a year-end rally. That would not, in fact, surprise me at all. But I wouldn't stay short too long because I think after you get the certainty around the election, regardless of who is elected, you're going to see a rally into year-end as the market absorbs all the new news. So what we like to do over here at Great Hill Capital is buy high-quality companies when they're on sale and hold on to them for a while.
Excellent advice. Excellent advice. Thomas Hayes, always a pleasure. Thank you so much for your insight.
Thank you, Sean.
And we're back. And then finally, both on the euphoria on months like July with excitement, and then days like today with a little volatility that we forgot exists normally in markets. Ben Graham had to say it best. Ben Graham's teacher said, quote, "Individuals who cannot master their emotions are ill-suited to profit from the investment process." So on months where everything that you own is up like crazy, it's easy to think you're a genius, but you have to keep an eye on the underlying fundamentals of the business. And then in days when things are down dramatically, you say to yourself, okay, what's changed about XYZ's ability to sell X? And if nothing's changed, then you ignore the short-term volatility. Moving on, want to get through some of the data now. Dudley, citing growing recession risks, urges Fed to cut rates as soon as what would have been yesterday. Jeffrey Gundlach, who runs Double Line, a huge bond shop, I think 80 billion under management, also said the Fed should have cut yesterday. And then when we saw the weak employment data this morning, which kind of threw the market into a tizzy, People started saying they should have. Jeremy Siegel was out saying 50 basis points is not off the table for September, so they might have to play a little catch up. I think they'll be be okay going in September. Let's see the numbers tomorrow. The good news is earnings are still holding up well, which will buy them enough time. But I think if they go much later than September, they're going to get a hard landing. And he couldn't say it any more clearly, which is, to Gunlack's point, if you're going to say that you're going in September, just go now. Like, what's the difference of 7 or 8 weeks? The key thing that's happening under the surface that no one's really talking about in the US aggressively is that Japan has been a global liquidity provider for 2 years while the rest of the world was tightening. And now they've moved abruptly into being a liquidity extractor by tightening and starting to discontinue their quantitative easing. And what is a seamless transition would be if the Fed started easing at the same time that Japan was tightening. But since there's a 6-week, 8-week window that's not the case, we could see issues with short-term liquidity, and that will finally force the Fed's hand. So this type of volatility should be expected. You saw the Nikkei was down 3% overnight, and then we opened up strong, which made little sense. So let's just see. My guess is you're going to see more Fed liquidity provisioning in the repurchases of balance sheet roll-off. So they'll probably ramp that up for the next 6 weeks until they can finally get the cut in action. And whether that will be enough or not, time will tell. But today, the market was saying, we're worried about liquidity, particularly when you have the labor market headed towards what they call the SOM rule, which means when the unemployment rate rises at a particular pace, it tends to signal a recession, and we're getting close to that pace. So it's got a lot of people worried. I'm less worried, but watching it like a hawk. And Powell seemed very nervous and very focused and very reading from a script yesterday that he's fully aware, and emphasized the two-sided risks as we covered with Sean. Now, on the flip side, U.S. business activity expands by the most in more than 2 years. So there's runway for, I think, 6 to 8 weeks to get that cut in and then kind of catch a soft landing here. Retail inventories are starting to go up, destock to restock cycle, which we've been talking about. UK manufacturing is recovering. That's good for GXO. UK business activity picks up after pre-election low. That's good. US dollar, Japanese yen. Japanese yen is collapsing as we anticipated. It started in July. It's absolutely rolling over big time, and that's going to be good in time for China. It's it's taking forever, but it's all of the pieces of the script that we needed to play out are playing out. Have we gotten a bazooka? No, but we've gotten a ton of small shotgun rounds that added together could be the equivalent of a cannon with a time lag. And then we're getting the 180 million in new buyers. So I love seeing this yen weaken. Strengthen relative to the US dollar. That was key to get the hot money flows that came from China to Japan and India. Everyone thought those were fundamentally based. We disagree. And as the yen strengthens, we'll see if those hot money flows flow back into China. When it happens all at once. We got a taste of that with cyclicals and small caps and banks in the month of July. They all just went up all at the same time, as we had been calling for in the sea change public appearances that we had on Fox in late June and early July. And sure enough, it came, and it came very, very quickly. You're seeing microcap even start to outperform the S&P 500. And then some key quotes where you're seeing Knight-Swift. This is from earnings this week. Knight-Swift Transportation. The early signs of a market setting up to change. So the transports have been smoked, and now they're starting to see some light at the end of the tunnel. The other thing that was interesting, there were two semiconductor companies, I'm trying to remember if it was Qualcomm or NXPI, who had like 87% year-on-year growth in semiconductor demand for autos, which is a nice look through for Cooper Standard. We'll see. There was a plant shutdown in June, so time will tell. We'll see what the earnings tell us. Texas Instruments, momentum across all markets. United Rentals showing particular strength in manufacturing. That's been a key part of our thesis. There's been some mixed numbers, but I think on balance, it's recovering out of a 2-year recession. Canadian Railways is moving right. They're seeing, let's see, North America production trending slightly positive. Tesla, people are underestimating this demand for grid storage, probably by orders of magnitude, which helps Generac, and we saw that. Okay, Alphabet, the risk of underinvesting is dramatically greater than the risk of overinvesting. We're going to cover that. It goes back to the Sequoia article about the $600 billion question, which basically states the amount that they've been spending hoarding semiconductors would have to generate $600 billion of new revenue in order to maintain margins. So what you saw with Microsoft, 77% growth in CapEx and a 15% growth in revenue, means their margins are going to go to hell in the short term, which is why this rotation is going to be sustained. And you're seeing decelerating earnings growth in big tech and accelerating earnings growth in the unmagnificent 493 and small caps. Royal Caribbean, robust booking and pricing. Earnings estimates are up 1% since July 1st, so that's a positive thing. With S&P up in aggregate. The only group that's down is energy, which is kind of interesting. When you consider the data that just came out, we used the most amount of natural gas for energy than we've ever used in history last month. So that's positive. Financials are the biggest part of the upward revisions. We did take some Citi and Bank of America off in the last week or so to lock in profits. Those have been big movers for us. And maybe we can redeploy at lower levels. We'll see how that works out. But sometimes you got to ring the register. Mentions of weak demand are also, and Buffett, you saw Buffett out there selling a ton of Bank of America. I don't really pay much attention to that anymore, but it's been such aggressive selling that it was noted, especially when they were overbought, trading at a premium to book, all the things that are the opposite of why I buy. But I do want to get back into those because I don't think the banking cycle has even begun yet. And we've got some still, but less than we did, and booked a nice profit on that. If you look at the Citi chart, it was a big one for us. So okay, moving along. Mentions of weak demand remain elevated but are rolling over. This is what you see after bottoms like 2009 to 2010 and mid-2000 to 2020 to 2021. So that rolling over, same as mid-cycle 2012 and 13. So that's positive. First EPS growth quarter for the other 493. We've talked about this. This is the updated numbers. And what you're basically seeing here is Q3, Mag 7 or 18% earnings growth, but ex Mag 7 is 5% earnings growth. Excuse me. Q2. Okay, yeah, Q2. So this is the one we're seeing right now. 30% was Mag 7, 7% was the other 493. But what you see here in first quarter of 2023, you had negative for the 493, negative 1%, then Q2, negative 7%, then 0% growth for 3 quarters. So this is the first inflecting quarter for the 493, and that's why you're starting to see them tick up, and you're going to see them continue to accelerate into Q4 to low double digits, and sustain that for all the way through end of 2025, which is a big deal. Whereas the Mag 7, which started the year at 53% earnings growth, are going to decelerate all the way down to high teens. Still doing good numbers, but that changes the multiple profile for some of these stocks, especially when margins will compress from all the CapEx and chip hoarding. Q2 is expected okay, we did that. And that destocking cycle is coming to an end. This has been our core theme. To the restocking cycle, this is back to the midline here. This is what you saw in 2010 at the beginning of the cycle, in 2001 and 2 in the beginning of the cycle for multi-years. That's very, very positive. That's why you're seeing Stanley Black & Decker, 3M having its biggest one-day move in history. That one was a long time coming, but when it comes all at once. New orders, inventories ticking up, so that's positive. Decade of underinvestment. Stuff is old. Private, non-residential, fixed assets and structures. So there's a catch-up trade for CapEx. Manufacturing capacity starting to grow after 10 years of stagnation. That's the onshoring theme. Earnings estimates, we covered that. Risk reward still favorable to cyclicals. This is the S&P 500 versus Russell 2000 relative valuations. Large is expensive, small is cheap. The historical mean is significantly above here, and you can't get anywhere near this low until you go all the way back to when? 2001, and small caps had a monster historic rally from 2001 to 2007. So yes, 13% move in a month was a lot. Probably takes a breather. Love this new mug with the handle. My buddy is down in Dallas. Okay, USPC inflation, we know all that's rolling over. Positioning across sector groups, you're still with the Z scores dramatically overweight Magnificent 7, which is why you continue to see that refresh. NVIDIA got down almost below 100. If you remember, we put out the next pain trade article. It was 100, got up to 139 that day. So it's down. It's already done it. It looks like you could get a counter trend move in some of these tech stocks that have fallen a long way. We'll keep an eye on it, but I think the trend is the rotation is going to stay intact. So even if they bounce a bit, I think they continue to underperform for the next 6 to 12 months while the rest of the market starts to outperform. If you look at the positioning of mega cap growth in tech, it's still extreme here. Equity positioning across sectors, we covered that. Then you got the Russell 2000 to S&P 500. Look how this thing turned the corner overnight. When it comes all at once, so you can see that visually. And for those of you listening, if you listen, that's fantastic. If you watch it, you will get more value because you can see things that, I'm just a data person, so I like to look at it. But look, listening is better than not doing anything in terms of getting information. You can see the equity sentiment was unchanged in June. It's kind of mid-level, moving towards extreme, but not anywhere near there yet. Wake me up when September ends. Annualized S&P price return by month. So July is a great month, and that was clear with average 22% annualized. So if you take it times 12, for those of you who aren't familiar with these terms, August is not that bad. It's more like June, which can be choppy, but tends to be okay. September is kind of the worst month of the year. So I think if we get continued strength for the next few weeks, there's also some stats. I think I have the chart in here where after the first cut, the first month is weak, but then you get 3 months, 6 months, 12 months. It's all good. So that kind of lines up the 17th and 18th. Maybe would be nice to see strength into that. If we could get strength into early September, that's when we could start to get defensive and maybe put on some tactical shorts ahead of the election, and then be positioned and create some extra free cash to ride the year-end post-election rally similar to 2016 for those of you who were around. Only 5% of firms currently use AI, suggesting limited growth. I don't know if I agree with that second part of the statement, but I think there is an overstatement as to the current value. Dividends likely to contribute more than during the past decade. So in the past decade, dividend return was 16% of total return. Price return was 84. But if you go back to 1936 through now, dividends represented a third of the returns, about 36% of the returns versus price 64, which is in line with the 493 outperforming because most of them are dividend stocks. And you see in our portfolio, we have a lot of dividend stocks that have started to do exceptionally well. So look at this moving forward. China bond yields at all-time lows. They're starting to defend this. As we said, watch this as an indicator for equities to start to turn that 2016 to 2018 move. 29 to 2011. This needs to turn. It will all turn at once. This is an extreme like we saw in 2020, and you got a monster rally into 2021 as well every time. We expect another owner's equivalent rent in July. Fine, that's great. Dallas Fed manufacturing. This is where you see the mixed stuff regionally. Excess COVID-related money has waned. Inflation should maintain its downward trend. Dallas Fed manufacturing expected new orders. So current new orders were not good. Expected new orders are looking really, really good. This is really coming out of a trough here, so it's good to see. Little delinquency rate moving up in credit cards at the lower end of the consumer, something to keep an eye on. So noted, and I'm sure the Fed is looking at, we hope the Fed is looking at that as well, but it's historically low, even though it's rising. Share of households planning to move over the next 12 months has increased recently. So with expectations of rates coming down, I think people are finally going to say if they can get 25 or 50 basis points down, they'll sell their house and finally move. Japanese yen leveraged funds. So that was at the extreme. China's government bond yield, we covered that. This is the Bloomberg Economic Surprise Index in purple relative to the S&P 500. So this is starting to turn back up, which is what we want to see. The market came in a little bit to follow that, but the market, meaning the Mag 7 in the cap weighted, everything else went up. Here we have the KBE Bank Index. Had a monster month, by the way. Regional banks were up 18.3% last month, which is unbelievable. The basket, not just one stock that had a good run, the basket, which means somewhere up 40%. Declining share of Americans say they're likely to consider buying an electric car. Weekly flows by client and sector, so they were starting to flow out of tech finally. Today's largest 7 are cheaper and of higher quality than 2000. We've covered that in the past. That's from Ned Davis Research, showing us that we're not going to have another 90% down NASDAQ, everyone pointing to the Cisco's chart. It's nothing like that because these do have earnings power. They're decelerating earnings power, but huge free cash flow, and they'll get to a multiple attractive enough that bids will come in. Unless they dramatically overspend, then they'll come down more. This is job openings. JOLTS has dropped all the way back down to pre-pandemic levels. Job quitting falls to nearly 4-year low, and job openings dip in signed labor market is cooling. Here's the quit rate collapsing. Bank of Japan raises benchmark interest rate, outlines roadmap for trimming bond buying programs. So this all happened in the last week. We said it was coming. It's coming. Now it's here. And that's caused a liquidity shock that we have to keep an eye on. But I think the Fed will use its other facilities to bridge time over the next 6 weeks and actually be in the market repurchasing roll-off securities in size to keep the liquidity flowing until they actually do the cut. Here's the 2-year government bond yield starting to rip higher this year. Dollar yen we covered. 10-year government bond yield, I think, broke below 4% today. So that is, remember we said 3.75% before, 5% when it was at 490 and everyone was saying it was going back to 5. We said, nope, it's going to 375 before it goes to 5. And it's collapsed in that regard. TLT is up big time. Real estate is biggest source of distressed bonds and loans, so everything else is looking good. This is really, in the scheme of things, 194 billion is chicken feed relative to the overall market. 120 trillion dollars of assets. Delinquency rate of CMBS loans. There's going to be a pony in the pile here for someone that gets this right, but I think it's a little early. Foreclosures on the rise. Value of seized commercial properties, again, commercial. CapEx growth slowed in 2018-19 amid trade war. It's starting to pick up again. We covered the decelerating earnings of the Mag 7. Momentum tilt is well above average. This is starting to roll over. So if you're in all the Momo stocks, get ready for some more pain if you haven't experienced enough in July. This is the Slumer stuff from yesterday. Looked like Russell's trying to bottom here. NASDAQ's trying to bottom today. It checked back. My sense is we probably get a bounce from here. A lot of these tech stocks look oversold, but we'll see. Just instinct, and it feels like this market wants to hold up for another 4 to 6 weeks into the next Fed meeting and then sell the news. But that's not how we make our money anyway. It really doesn't impact how many generators are going to be sold, how many DeWalt trowels are Stanley trowels and DeWalt jackhammers are going to be sold, and drill bits and everything else. So we don't really worry about the day-to-day, but we like to keep an eye on everything. 10-year yield, yeah, that broke this downtrend line, so that's good to see. All of the stuff lining up for what we want to see in our portfolio and have started to see aggressively in the last 4 weeks. Banks exposure is still 1 standard deviation below average. So we're going to want to get involved again or rebuild that position. Citi was a big move, pulls back. We can add back like we've done with other stocks before. Beta cyclical bullish exposure is near all-time lows. This is what we want to take advantage of. And dividend yield is starting to move up. We were talking about it for months when it was all the way down here. Now it's starting to come in as we anticipated. Hedge fund positioning, long positions through their estimating short positions based on total short interest. Exposure to cyclical versus defensive sectors is at an all-time low. So this is why when hedge funds get this extreme against cyclicals, that's usually when you get the move, because they're caught off sides and they're the ones that chase. Discretionary is most shorted sector. Financials is the least shorted, which is why it kind of makes sense to short term, having taken some profits there in the short term. Highest net relative exposure to utilities, lowest to energy. If you remember, we were pounding the tables on utilities a year ago. They've had a monster run, and now they can't get enough of them. They'll probably continue to do well over time. I haven't looked at, let me just take a look at XLU here real quick. But the fact that hedge funds are getting excited and crowding in probably tells me that it's time to take a little bit of a break. And then they hate energy, so energy is sold off. Those will probably start to move sooner than we anticipate. Performance of the Russell 1000 versus value versus growth from starting forward PE spreads 1995 to 2019. So effectively in June 2024, we were at the 95th percentile of growth over value. And from that time period, what you see is a dramatic outperformance of value. As a matter of fact, value outperformed growth by 7% in the month of June alone. Value was up some 5%. Growth was down some 2%. So that was one of the widest spreads. Then you see here, value outperforms. You haven't seen value cheap relative to growth since 1937, and then in the next 30 years it was all value. So this is setting up, and that's also in line with more of the returns coming from dividends and rates coming down, and all of the things that go along with that. And people are going to want to see cash flow and tech margins coming down because they're going to do all this investment in AI. Here's a note from Generac. They took the price target up to 175 from 145. Opinion follows trend. Initial jobless claims. These are the things that guarantee a cut in September. This is Jeremy Siegel on Liz Klayman Show. By the way, I will be on Fox Business, the Klayman Countdown, live in studio with Liz Klayman tomorrow at 3 p.m. Very excited about that, so tune in if you're free. But Siegel was on today saying 50 basis points is not off the table in September, meaning they might have to play catch-up. Broadening out Magnificent 7 to decelerated. Rest is expected to improve, so that's a newer chart. Manufacturing PMI was weak this month, so we got to keep an eye on that. But there's some seasonality around that. It was also weak mid last year as well. Continuing jobless claims really starting to spike up, highest since November 27th, 2021. Initial jobless claims, highest going all the way back to September. And then more than 50% of 74 U.S. CPI components are running below 2% for 3 months now. So that's a big deal. This is from Fundstrat via Seth Golden. Get your small caps. What he's saying is that small caps early signal, early cycle in 11 of 12 trading sessions. The Russell 2000 traded plus minus 1%, only occurred 10 times since 1979 outside of recessions and bear marks. Early signal given years 87, 98, 2009, 2011, 2020. Forward returns and positivity rates, 1 month out up 10%. We saw that last month. 3 months out up 18%. 6 months out up 31%. 12 months out up 51%. All with a 100 positivity rate after you get past that first month, which we had in July. So expect more to come, meaning potentially another 40% more to come in small caps. This is also from Tom Lee via Seth Golden. 2-year yield minus Fed funds rate gap is a big risk on signal, which anticipates a 4 to 5% S&P 500 rally ahead, which would imply we do get a bounce from the tech Magnificent 7 stocks that have been beat down in. As a matter of fact, that basket, after I went on and talked about the sea change out of the Magnificent 7 into the unmagnificent 493, that basket, there's an ETF called Big T that is the Magnificent 7, and it dropped 15% over the next few weeks, the Magnificent 7, while the rest of the stuff, like banks, were up 18% and everything else. New vehicle total inventory. This is exactly what we wanted to see. We're going to start to see more incentives and more reasons to get people out, replacing those 13-and-a-half-year-old cars, which is going to be a big deal. And margins for the OEMs are going to go down because they're going to be in price wars, but doing big volumes. And like generators, when your neighbor gets one, you want one. And we're going to get a big refresh cycle in cars as the prices come down, as rates come down, as incentives go up, as inventories build. It's a good thing for Cooper Standard, which is not in the arms war. It's in the arms dealing business, which is what we want to be in. Okay, here's another thing from Jim Paulson via Seth Golden. Basically, he's talking about when the 10-year yield falls and M2 money supply rises like they are now. Historically, S&P delivers higher returns than when these two variables are not moving in opposite directions. So while everyone knows September is a bad month, when both of these things are happening, 10 yield is falling and money supply is rising, you often get positive months. So that could actually throw the weakness, pre-election weakness idea and September weakness and sell the news weakness out the window. I wouldn't bet on that, but I like the fact that I like the idea, despite what you saw today, I like the idea that the market holds up into September. We will see. Some of that will have to do with Apple earnings, which I think were okay after hours. I'm just looking at the screen while I'm talking, and Amazon. So we'll see how those come in. If those two can bounce, even if NVIDIA keeps falling, I think that we'll get the bounce in the S&P 500. First time since 2020 that we've seen 6 straight declines in the 10-year yield of 2 basis points or more. So that's that. The change in the Fed statement here leads to September for sure. ADP employment. I think we're getting close to the end here. And then July performance. This is very important. I just ran these numbers in advance of going on Clayman tomorrow. For July, the S&P was only up 1%. Dow was up 4.5%. Russell small caps were up 10.4%. And the NASDAQ was down 1.68%. Small banks were up 18.6%. REITs were up 7.5%. Utilities were up 7%. Industrials were up 5%. And Mag 7 was down 35 basis points. Semiconductors were down 5%. Here's 80% of global central banks are expected to be in easing mode by the end of 2024 versus only 10% in July 2023. That's good news. But right now, Japan is tightening and not enough of the West is easing yet. So I think you could see some choppiness unless they use other facilities to paper it over until September. Consensus 12-month forward EPS growth projections continue to trend up across regions. That's Asia Pacific, Europe, and the US. That's positive. More often than not, the S&P 500 delivered robust returns following the first Fed cut. Here's the S&P return since 1950 when the US economy did not see a recession within a year of the first Fed rate cut. So, first month after, the average return is negative 3%. So we want to keep that in mind as we, if we show continued strength into mid-September before the Fed meeting, that will be an opportunity for us to get more defensive, raise some cash, maybe put on some tactical shorts for that month into the election. And then 2 months after, you're up on average 7%, 3 months after up 10%, 6 months after 12%, 12 months after 15%. So I think this time will be similar. Moving along, sentiment survey, basically no change since last week. Bearishness went down, bullishness ticked up, and then on to some China stuff. Then we'll get to the US, and then we'll wind up. AI race, Alibaba, Tencent quickly adopt Meta's new Llama 3 model amid excitement. Hedge funds post biggest retreat on bearish yen bets since 2011. They were the most short that they've ever been. And of course, you had the most abrupt rally ever. All of the most crowded trades from July have unwound. Long Magnificent 7 was the most crowded trade. They got shellacked. They had a 15% drawdown, and depending on the company, a lot more than that. If you were in NVIDIA, it was like 35, 40. 35, you lost about a third of your money from that day we put out the pain trade article. Then short small caps was a crowded trade. That unwound. Short yen was a crowded trade. That unwound. And short China equities was a trade. It's trying to unwind, but it's just kind of grinding sideways. We'll see what earnings season has to do for that. Alibaba's international AI toolkit hits 500,000 merchant adopters. So all this stuff happening in the background doesn't matter until it does. China industrial profits climb, showing manufacturing strength. Doesn't matter until it does. Alibaba's share jump on plans to boost service fee for merchants. Doesn't matter until it does. Japan wanted higher inflation. It's here and it hurts. So there you go. Everyone who chased Chinese equities after they were up a gazillion are now starting to second think that. Alibaba Cloud raises prices for domain name auctions amid AI compute price war. China's Xi Jinping calls for faster measures to boost domestic consumption. So that came out of the Politburo meeting. Again, doesn't matter until it does, but all these things are happening in the background, and then they're all going to matter all at once. Alibaba's Taobao and ByteDance's Douyin seek e-commerce price war detente with new policies. Basically what they say is we're just killing each other. Let's form a cartel and charge higher prices. Good for owners. Yen soars to strongest since March as BOJ reignites rally. This is, tomorrow's newspaper today. We've been talking about this for weeks, what's going to happen. Japan's central bank hikes key rate hours before the Fed. China's basic self-sufficiency in chip-making tools could come this summer, veteran says. This was a big mistake to cut them off, because before they were not doing aggressive research and were dependent on us for their whole growth. Now they've been forced to learn how to do it themselves, which basically means they pull our best scientists, pay them a lot more money, and steal all of our intellectual property, whereas before we could just sell it to them and make money. But that's the policy of the current administration, and we'll see the effect of that as time goes on. Macau Casino Group, MGM, reports best ever June quarter as tourists return. Winning odds improve. Bears flee China stock markets as regulatory curbs squash short position to a 4-year low. It's a good setup. Discount shopping giant Temu's supply chain faces scrutiny as mainland sellers protest. Again, we remain of the opinion the numbers are either unsustainable or unreliable. Refer back to that Financial Times articles we referenced 8 weeks ago. Japanese stocks fall as investors fear effects of stronger yen. That was from this morning. Japan raises interest rates for second time since 2007. Disney Plus, Hulu, and Max launched their new streaming bundle at a 38% discount. So this is going to start to get traction. And then by the end of the year, they're going to add ESPN, which will be an unstoppable bundle. And this is what ValueAct did at Salesforce, New York Times, and Spotify, and they turned around all three companies. They're going to do the same thing with Disney. Disney's getting zero credit for its streaming and media and theatrical release business. The parks, experiences, and consumer products are worth about $80 to $90 a share. That's what the market's pricing. It's giving zero value for 153 million subscribers at Disney Plus, compared to Netflix has 277 million, and they're valued at $250 billion. So we think that business is worth a lot more, okay, than zero, and that's why we think it can be $180, $200 stock in the next 3 or so years. Opinion, not advice. Check. Click on terms at hedgefundtips.com. Check with your financial advisor. Don't do anything at all. All right. China's Politburo meeting sends positive vibes to investors after third plenum disappoints. So that was their kind of backtrack. Market didn't really respond because of everything else going on. Why 3M stock rose 23% on Friday. So all that's coming. The new CEO is doing a great job. We'll cover some of that in our article of the week. Buffett cuts Bank of America's stake, unloading $3 billion this month. So most crowded trades are getting liquidated. We saw that coming. PayPal stock rises sharply after beat and raise quarter. We're going to cover that. 3M stock had its very best day ever. The new CEO started with a bang. We'll cover that. In a troubled box office, premium still sells. That was the biggest R-rated movie launch ever. Deadpool and Wolverine is owned by Marvel, owned by Disney. So that's two monster blockbusters in the same year. Markets attributing zero value to that. Inside Out was $1 billion. Inside Out 2 was $1 billion deal, and Deadpool's going to be a beast as well. Nvidia stock swoon didn't slow CEO Jensen Huang's sales, so he continues to dump stocks on all the retail investors' head who bought the split. Wall Street says buy stocks that pay dividends with $6 trillion of cash ready to be deployed. As rates come down, they're going to be forced out of their money markets and everything else, and they're going to go into dividend stocks, and that's where value is going to continue to outperform growth. PayPal stock soars as earnings bring big positive surprise on this key number. What's the key number? Is transaction margin dollars, which was the name of the game that everyone was worried about, and they've turned the corner as anticipated. That move is just beginning. Bank of England decision, another central bank cuts ahead of the Fed. Disney bets on Deadpool, Wolverine, and dirty jokes to save Marvel, whatever it takes. Like I told you, Bob Iger will play Bible movies 24/7 if it means EBITDA will go back up. They learned their lessons. They went woke, but they don't want to go broke, so they're pivoting. XBO earnings show U.S. manufacturing improve, shares rise. Fed clears path for September interest rate cut. That's after the fact. Tim Moreos, the Fed whisperer, wrote that, so it's telling us what we already know. There's Gunlack saying they should have cut yesterday. We agree. U.S. productivity rebounds sharply in the second quarter, which could help a soft landing. So you're seeing all these mixed things. There's enough good happening to overcome the Fed sucking its thumb. But if they suck for too long, we're going to wind up with some issues. So, and it's going to cost them much more, and it'll go down as one of the worst Fed chairs in history versus one of the best. And the difference between those two binary outcomes could be, 2 months difference, or in this case, 6 or 8 weeks. But I think he can get away with sitting on his hands in July, but he won't be able to get away with sitting on his hands in September. Initial jobless claims rise to one-year high as hiring slows. That's the key message. China revs up U.S. Up fiscal policy support to spur economic recovery, so they're back at it. Can Kelly Ortberg turn Boeing around? People like him from Rockwell Collins. He had a huge run with his stock while he was running that. I think he's going to do the same for Boeing. Since 1995, value stocks have always outperformed when they're this cheap by a big margin. And so we covered these two charts earlier. Intel to cut. Okay, so Intel reported after hours. Their stock is down. I want to listen to the call. He's going to be on CNBC tomorrow. My guess is if it was a disaster, he would throw his CFO on instead of himself. So he'll be there tomorrow to talk it up. But this really does not change the long-term strategy. So they're cutting a bunch of costs. They missed by a hair. I'll wait and listen to the call tonight before we add any shares or make a decision whether we're going to add any shares. But we're comfortable with ours. If you remember, we bought at 25. We sold 2/3 at 48, and then we rebuilt the position between 29 and 31. So we've made some money on it. The question is, do we want to add more back at 25 or 24, wherever it is after hours? And after the call, I'll make that decision. But more likely than not, I think it makes sense, and unless I hear something in the call that's egregious. But the legacy business, so revenue declined by 1%. That's not the end of the world. And remember, the whole growth story is the $45 billion of grants, tax breaks, and loans from the U.S. government to stand up a duopoly with Taiwan Semiconductor that all the Western Fortune 500s are going to push their demand through due to government pressure. So that's not in the numbers yet. Canada Goose reported surprisingly okay, given that it's off season. They were able, so the wholesale continues to go down, the direct to consumer continues to go up, which is going to increase margins over time, which we like. China was up again. I was a little worried about China because every other company had China down, but China was actually up. And Asia Pacific was up. So those were strong regions overall for the company. Revenues were up a few percent, and then their margins were a little bit worse because they bought a new factory that they have to take the costs out of, so they had some impact. But revenues for the quarter were up, 5% basically. From 84 to 88 million year on year. So the business continues to do well, and it is what is considered to be a weak quarter. So I'll listen to that one. That one came out today as well. Pals, Trowels, and Towels, stock market and sentiment results. We had some really good earnings results in the last week. Pretty excited about that. And I think ultimately what you're going to see here, and what I was trying to talk to Neil Cavuto about, was that you've got an AI arms race between Microsoft, Google, and Amazon, and the arms dealers look like they're winning, which is NVIDIA, AMD, and Intel in the short term. But I think you're going to see couple of things is that you've got, like you saw, AMD earnings were good because demand for their GPUs went up. So not everyone wants only NVIDIA. And if you saw Meta's report, yeah, they were going to have like 100,000 H100s, but then another 350,000 other GPUs, which, other could be Intel. As we know, the Gaudi 3 is 50% faster, 50% cheaper, and uses 40% less energy, which is a huge operating cost for these data centers for the hyperscalers. So I think NVIDIA's margin is going to be Intel's opportunity. And then Microsoft, Google, and Amazon in short term are going to have declining margins as they continue aggressive CapEx until the shareholders stop them. But Sequoia put out the key article, which was the $600 billion question, which says that the amount that they're spending right now is not even remotely justified by earnings. So their margins are going to crash. And that's why you see the decelerating earnings in that group and that their stock started to move down. Okay. PayPal update. So they had their best transaction margin dollar growth since 2021. They raised their 2024 guidance and increased the share repurchase. They're coming from a position of strength. So what does that mean? The most important thing that came out of this call is that they said, we're not going to do $5 billion of free cash flow this year. We're actually going to do $6 billion of free cash flow this year. And you can't give away the stock. It's mind-boggling. Oh, and by the way, we're not going to buy $5 billion of stock back this year like we did last year. We're going to buy $6 billion back of stock, which means you're going to own a bigger slice of the pie without putting any new money out of pocket. Revenues were up 8%. Transaction margin dollars were up 8% year on year. Operating income was up 17% year on year. Operating margin expanded 126 basis points. EPS increased 17%. That's a growth company, ladies and gentlemen. Not a value trap. That's a growth company. Total payment volume up 11%. Payment transactions 8%. They even re-accelerated active accounts by almost 2 million sequentially from last quarter to this quarter and generated $1.4 billion of free cash flow in this quarter alone. They've got $18 billion of cash, by the way. Net cash about $6 billion, $12 billion of debt, returned $1.5 billion to stockholders, buying 24 million shares of common stock at low prices, by the way, which is when you want them to buy it, which is the name of the game. So you can see here every metric basically up, margins up, revenues up, transactions up, share count collapsing, went from in 2023 1.1 billion to just over 1.04 billion. So they've taken out, 60 million shares, give or take. No, 60, 58, 78 million shares. I mean, that's pretty awesome. And that's going to go down. They're going to be below a billion shares, which is pretty exciting. All right, then you got adjusted free cash flow. Active accounts were up 2 million sequentially. Transactions per active account up 11%, driven by Braintree transaction growth, which is what everyone hated because it brought the overall margins and take rate down. Now that's reaccelerating. Remember, Fastlane increased conversion from 50% to 80%. That's rolling out in earnest the second half. That's going to be huge for the company. Their ad business is rolling out. They just did a deal with DoorDash and others. Then you've got their guidance. They took up not only on free cash flow and buybacks, but they took up their transaction margin dollars from before slightly positive to low to mid-single digit growth for fiscal year 2024. For non-GAAP, non-transaction operating expenses, then you've got effective tax rate. That's not a big deal. EPS. They went from mid to high single digit growth to low to mid teens growth. That is a monstrous difference. And then they took up their GAAP EPS to 388 to 398 range from 365, which is another huge jump. And then free cash flow and share repurchase. So it's huge. Absolutely huge. Venmo momentum continues to build and monthly active accounts increase across PayPal and Venmo. Fastlane and ads platform is a big deal. Expand our addressable market, turn into a growth company, which is a big deal, deepening our partnership. They're doing a huge deal with Meta. Okay, so one great Meta, which we already partner with on multiple fronts. PayPal is a top payment method for advertisers and consumers globally across Meta's family of apps. Meta's donations and charitable giving campaigns now run on PayPal Giving Fund platform. Meta pays out creators and developers using Hyperwallet, and Meta uses Braintree for credit card processing. Meta is Facebook and Instagram for those of you, and WhatsApp. We are working closely with Meta to optimize the experiences and look forward to deepening our partnership with Meta in mutually beneficial ways in months and years ahead. Foundation for our next phase of growth. They also renewed our contract with DoorDash to expand how we work together beyond unbranded PSP processing and offering our branded marks. DoorDash also relies on our risk capabilities to mitigate losses. They will be participating with our new ads platform. And remember, that changed the game for Amazon when they added the ads business. And for Uber, margin accretive, helping us to more profitable dynamic. We expect Fastlane generally available in the US in the second half of the year. So, and by the way, they're ascribing 0 to their guidance raise to the benefits that Fastlane is going to bring to their margin, which are going to be off the charts. Fastlane will accelerate PayPal's ability to capture roughly 60% share of e-commerce purchases made without a branded mark. Best-in-class checkout experience. In the second quarter, we launched in-app offers with major brands including Best Buy, Priceline, Lyft, Instacart, Ticketmaster, Walmart, and Nordstrom. Redesigned vaulting payment page alone shows a conversion lift of 75 to 111 basis points. In fact, we drove almost 20 million app logins from our post-purchase experiences in June alone, growing more than 70% from a year ago. Turning to Venmo, we're building on the business's strong market position. In the second quarter, Venmo processed more than $73 billion in total payment volume, growing 8% year over year, with monthly active increasing 5% year over year to nearly 62 million. Both the strong base of peer-to-peer users and adoption of our ecosystem of products are driving this growth. For example, both Venmo debit card and Pay with Venmo monthly active users grew 30%. We launched a push provisioning of the Venmo debit card to Apple and Google wallets and continue to enable PayPal Pay with Venmo with merchants and partners, including eBay and StubHub. Recently launched Venmo Teen. Venmo is primed for growth, making it easier to add PayPal and Venmo branded cards to Apple and Google wallets on mobile devices, etc., etc. So we were encouraged to see the sustained total active account growth following a positive inflection in the first quarter. So they went from contracting to expansion. That's what you want to see at inflection points. Transactions per active account, which is a trailing 12-month number, with 60.9 in the second quarter, up 11%. Transactions per active account grew 6%. Total payment volume grew 11%. And total payment volume international also grew 11%, etc. So there's just unbelievable things happening since this guy took over. PayPal generated $1.4 billion in free cash flow, $1.5 billion in share purchases, bringing repurchases to $5 billion, raising our guidance. Reaccelerating durable, profitable growth for the company. Given the strong start to the year, we are raising our free cash flow guidance. We covered that. Grew profitably. Venmo customers, Venmo ecosystem, Fastlane conversion from 50 to 80%. We covered. Okay, regarding Apple Pay, let me, though, set the context of the reality today and then how we think about the future. So reality today, we are the #1 branded experience across all platforms and devices. If we narrow down into desktop web, which is still 40 to 50% of all checkout, we see no degradation in our share over the past 4 years. Let me say that again. We've held share despite competition. Second, if we look across browsers, there's actually no difference in our selection rate across different browsers. So certain buttons moving from one platform to another just isn't material to us. So that's where we are today. Let us focus on our ability to get branded experience rolled out to 80% acceptance rate. Okay, so they're basically talking about their strategy. Stanley Black & Decker. So, I mean, these things are starting to move. Stanley Black & Decker up from $77 to $107 in the last, month. That's a pretty big move. Basically, they had lower inventory destocking costs, which is going to lead to restocking, like we've said, supply chain transformation benefits and reduced shipping costs. They should just outsource to GXO, by the way. On track for expected pre-tax run rate savings of $1.5 billion by the end of 2024. They've already done 1.3 and $2 billion by the end of 2025. I think we had done the math on that, and it was worth like $80 a share at the normal historic multiple, and that excludes the business. But anyway, let's just stick to the facts here. Organic revenue growth led by DeWalt, which is good. Gross margin was up 600 basis points to 28.4. Their goal is to get to back to 35%, which they will. Cash from operating activities was $573 million. Free cash flow was $486 million. That's what you want to see in a turnaround story. They have runway. And they raised their earnings guidance to basically 80-40, basically 410 midpoint from a 4.0 midpoint. So 370 to 450 from 350 to 450. And they raised their free cash flow to 750 million midpoint from a $700 million midpoint. So that's huge. Supply chain improvements, volume growth, reaccelerating, all the things you want to hear. Cost cuts, and then getting back to growth and getting revenues growing again. So they're focused on all of it. 3M, again, huge move here since February or last, if you go into the fall, remember the last quarter, we had that huge run from 68 to 90. Then it checked back to 74. It's gone from 74 to 128 in the last 4 months. This one's a beast. Plus, we also got Solventum for free with the spinoff. So, these things take time, but when they go all at once. So their organic growth was up modestly. Their GAAP EPS was up 117%. Adjusted EPS up 39%. Operating cash flow, $1 billion. Adjusted free cash flow was $1.2 billion. So they're free cash flow generative. And they are increasing their guidance from a 705 midpoint to a 715 midpoint, which is really good. And everything's hitting on all cylinders. Again, a new CEO, new jockey, turnaround story, and things moving in the right direction. They returned $786 million to shareholders via dividends and share repurchases, and moved up their endpoint. So you can go through some of these on the different divisions, whether it's safety and industrial, transportation, electronics, consumer, full year guidance. They took their adjusted operating margin up from a 237 bips midpoint, increased to a 250 bips. So they're going faster than they expected, which is a good thing. And all is in place. So they've talked about spinning out the business, all the things that they've already accomplished, and strong balance sheet. We repurchased about $400 million of stock in the second quarter, have the capacity to do more in the second half of next year. They're going to do acquisitions. I'll be taking a fresh, dispassionate look not only at M&A, but at our portfolio to determine if there's any assets that have greater value owned by others. And along the same line, what assets might be a good fit for 3M. Don't have anything to say on that yet. So he's doing the portfolio management, which is a good thing. Moving on, retail earnings, top 30 weights of the sector. Estimates were revised up for next year by 3 bips, down for this year by 62 bips. Transports were both revised down for this year and next year, 340 bips and 360 bips. So you have to keep an eye on it. My guess is that's skewed to one company though. So Uber has come down. No, let's see here. Let's see where the big hit was. FedEx a little bit. Oh, probably UPS. Where's UPS? Yeah, UPS was a big contributor to that. SAIA. And those look like the big ones. All right. Tomorrow we've got the jobs report. Expected private non-farm payrolls expected to be plus 176. We probably want to see a bit lower than 176 in order to keep the September guarantee on the table, but not so much more that people panic that there's no backstop before September. So you don't want to see a super low number. Also watch the revisions downward. And then finally, this is the stuff that's holding up the market. Here our margins are re-accelerating from the destock to the restock cycle. And then you see earnings growth is 9.8 versus 8.9% estimates. As I said, expectations were high. Secret to happiness is low expectations. So it's coming in higher, but not as high above as it had in previous quarters. So you're getting a little chop here. And then estimates have been a little soft the last few months. So we want to see a little reacceleration. We saw 1% since the beginning of July. Let's see if that persists after we get to the end of this week with so many companies having reported. So let's get on to, first off, I want to say I showed gratitude for all the clients and all the new clients. I want to express my gratitude for all of the longtime listeners that have been with us since the beginning, that have recently joined us, but most importantly, those that take the time to comment and like and subscribe on the YouTube channel. That really drives growth, because when they see a lot of likes and a lot of subscribes and a lot of comment activity, they show it to more people that are interested in the stock market when they log into YouTube. So the more you do that, the better. And especially for those of you who have taken the time to just share it with one or two friends or family members that love the markets that you think would benefit from this information, because that also leads us to some great people that wind up becoming clients, that wind up becoming longtime listeners and users. And we're very, very grateful for that. So without you, none of this would be possible. I am very grateful for whatever level you participate at. And with that said, we are going to go on to the Ask Me Anything question. For those of you who just like the podcast part, we'll see you next week. For those of you who like the Ask Me Anything question, here we go. Edgard Abreu says, first of all, thanks for the quality information you provide every day and week. I've been listening for 2 years, changed my way to investing. I'd like you to have a look at CrowdStrike. Very niche market, getting bigger by the day, 18% market share. Recent events provide a buy opportunity. We cannot quantify how much they're going to have to pay out. One airline asked them for $500 million. That's number one. Number two, a friend actually contacted me on this who owned it. And, he was saying that, my first response to him was, look, I don't own stocks like that. When he contacted me, it was trading at $75 billion. Now it's at 54 billion, by the way. But that was after the first fall. It was trading at 75 billion. And I said, look, it was trading at 16 times sales. That's not a business I would ever own in a million years, irrespective of how high the momentum goes or anything else. So, so would I own it at 11 times sales? And the answer is 11 times sales and 40 times earnings. What's the earnings growth? 20 times? No, I probably wouldn't. So could it get a bounce, with a tech bounce? Sure, it could, but I don't think there's any way to quantify this risk. So for me, it's a pass. There's down and down for a reason. So that's that. Alan Hare, morning, Tom. Been listening for a while. Really enjoyed the content. Know in the past you mentioned no interest in Ford or GM. But after Ford's big drop last week, has that impacted your opinion? Okay, so Ford and GM are annuity and healthcare companies with a car business attached on the side. And for that reason, I will never own an OEM, a union-based business, because you don't control your margins, you don't control your future, and in that regard, sold to you. So Jim Jones, would you look at Smith & Wesson? I've looked at this thing a million times. The numbers look great, and the stock never does anything. So I would say no, but I'll just take one more look at it because it's been a while. Smith and Wesson. Well, let me just type in Wesson. All right, SWBI. All right, so it's trading at about half off. What's happening with the business? SWBI. So I guess these people are asking me because they think it's going to do really well if there's a change in administration. I think it doesn't matter because, look, the last administration came in here. The stock collapsed from 2016 to 2020. It went from 20 down to 3. And then under the current administration, where you think it would do terrible, it went from 3 to 35. So, all right. Well, there you go. Now, cash flow is re-accelerating, but revenues are collapsing. Gross margins collapsing. I'm going to say pass. Not for me. I understand why you're looking at it. Maybe it works, but I wouldn't be interested. Zach Tan, like your opinion on a potential hedge between Cooper Standard and Advanced Auto Parts, given the age of vehicles is hitting 13.5. Do you agree that stock movements could complement each other when fundamentals either shift bullish or bearish for vehicle production, besides being backed by market fundamentals, huge operators that are being worked on supply chain? They're not going to hedge each other. They're discrete businesses. Okay, the people who won't be able to get in new cars, that aren't the 18 million people, is 315 million other people that have old crappy cars that have to fix them. So once they fix the business, it's going to mint money again, and I think they're both great. So they're not hedging anything. Don't overcomplicate it. They're two discrete businesses. Can you take a look at global payment networks and ArcelorMittal? Mittal we did. I'm not interested in that business. GPN is it's too opaque for me because you've got consumer debt that I can't quantify, and I don't understand what's on off balance sheet, on balance sheet. So for me, it's probably a pass. I understand SWPI, not SWPI. GPN is getting cheap, but US operates the issuer, merchant settlement and funding, chargeback resolution, array of software, streamlined businesses. I've got enough payments business with the PayPal. I'll just focus on that. GPN. Let's see here. I mean, look, it's a low quality business. It's definitely trading towards the low end of its range. I mean, if you want to take a little risk, I don't like the business enough. I'm just going to tell you, I looked at it in the past. I think it could certainly bounce from here and keep going. I just don't love it here. So I'm going to pass, even though it does look attractive and I understand how you got there. But it's not for me. Martin Florini, love to hear your thoughts on TBBB. It's a Mexican food chain. Along the lines of Aldi, growing revenue in stores. Supermarkets are not good businesses unless you're Walmart. So I'm probably a pass. There's really not enough information for me, and not enough of an operating history for me to get comfortable. I generally only invest in public companies that have, I mean, you'd have to pull up the prospectus and see their last 20 years of data. I mean, I understand wanting to get some exposure to Mexico. Don't get me wrong. Gross margin is mid-teens. Free cash flow is growing. Revenues are growing. Yeah, it's just not for me. I don't think there's anything wrong with it, but it's not the kind of business that I invest in. Doesn't mean it won't work. It certainly could, but it's going to work without me. Adam, thoughts on Whirlpool? We've covered this one. I think it's okay. I think you're going to get the cycle back going here again. And you get a dividend while you wait. I think there was a problem with cash flow with this one, though. Yeah, so it's just starting to reaccelerate. Revenues got hammered. So you just have to do your work and understand what's the plan to turn it around, and if it's a plausible plan, and who's doing the turnaround. And if you can get comfort with all those things, I mean, you probably have a decent enough margin of safety. Let's see where the balance sheet is. $1 billion of cash, $6.4 billion of debt on $1.5 billion of cash. So you definitely want to get a sense of when all of those are maturing. Like in the case of Canada Goose, we've got a couple years to 2027, same as Cooper Standard. So we're comfortable there. So you got to get comfort on that. But all in, you should probably be able to make this one work, Adam, after you do your work. Longtime listener, Stefan from Canada. Paycom, we've covered that a bunch of times, and we passed on it all times. I don't have any edge as to what their mode is. So for me, it's a pass. I don't know how they retain share, but the numbers look definitely attractive, even though revenue growth is decelerating. So then you're going to get multiple contraction. The question is, what was the multiple? So 5 times sales, 20 times earnings. What's the earnings? Cash flow is probably a cash machine. Yes. Capital. Yeah, I mean, look, if you can get comfort that they're going to maintain their moat and what they have is impenetrable, then yeah, I mean, it looks great on paper. But that's a big project to get comfort that their moat is going to not erode. And I understand why you got there, and there's probably something to it. But, oftentimes when these things break, they just take a long time. So for that reason, I'm going to take a pass on that one, even though it could certainly work for you after you do more work. Next is Sam R. What's your opinion on macro legends like Soros, Druckenmiller, and macro hedge funds in general? Hard to be consistently good and more one-off amazing trade that defines them. I think it's just a different way to make money. I mean, there's a ton of ways to make money. There's not one right way. So in the case of Druckenmiller and Soros, which is basically the same thing, they had a monster trade where they shorted the British pound and they got lucky with some policy changes. But, over time, Druckenmiller has delivered. So it's a different style. So has Buffett. So has the guy at Renaissance who does, high frequency trading. It's just many different ways to make money. So I've got nothing really to say other than congratulations on an incredible long-term track record. Same thing I would say to Buffett and many others. So River Rahi, you just have to know what you're good at. That's really what it comes down to. I like the time arbitrage business. Buy quality businesses, ignore the short-term noise. As long as the fundamentals are improving, eventually the price will catch up. Use low leverage so you can live to see the realization, and over time you're going to compound. Some double and triple much faster than you anticipate, and some take longer, but on balance you can outperform if you have a great framework. River Rahe, recent listener, love your podcast, changed my investing strategy, sleep better at night. What do you think of AKTR? At Corey, ATKR. Where were you at $10? It's at $130. Let's take a look. ATKR. Cash flow is decelerating. Revenues are decelerating. Margins have stopped improving. Revenues are decelerating. I don't like that at all. Still a free cash flow machine. cheap in terms of multiples. Compounder capital, what do they do? So electrical, safety, infrastructure products and solutions. Company with conduits, cables, installation accessories, metal framing, medical pipe, tube, conduit, cable systems, plastics. Kind of Alticore. I would just need to understand what's the biggest portion. It looks. I hate when companies have a gazillion things in their description. Find out where most of their revenues come from, and then do channel checks on the competition and figure out why they're growing so fast and if their moat can be penetrated. And if not, then you probably have a decent stock, but it's not something that I would be involved in, despite the numbers doing okay. I'm a little weary of that revenue deceleration after a 10-bagger move as well. That concerns me. So for that reason, I would pass. And with that said, congratulations, ladies and gentlemen, on 250 amazing episodes. We'll be back next week, same time, different place from Virginia. In the meantime, make it a great one. Bye for now.